want to start with what may be the obvious, but why this move? Why these funds and why a conversion?
Thanks for having me on the show. Really appreciate it. Yeah, why this move? When you look at the four funds that were converted, they're tax-managed funds, and they have a very long and strong track record. Some of the funds go back to the late 90s. And as the name suggests, they've been managed with an eye towards tax efficiency. And you look at their tax efficiency ratios over the past decade, they've been similar to many ETFs. The investors in those funds are clearly interested in taxes and after-tax returns. And so while we've been able to get similar tax efficiency ratios to ETFs in the past 20 years, we think that the additional benefits that an ETF brings to the table in terms of in-kind create redeems will help us even improve the tax efficiency further going forward. And of course, taxes are on a lot of investors' minds these days, so we think it's a good thing for the shareholders of those funds.
So Gerard, I want to dig into that a little bit more. Why choose to convert these mutual funds into ETFs versus just launching more ETFs?
Yeah, there's when you look at these funds, there's kind of at the intersection of tax management, systematic investing, so they lend themselves very well to an active, transparent vehicle. But one key point, I think, to bear in mind with this conversion is that we organized it so it was a tax-free reorganization. So what does that mean? That means that the shareholders go to bed on a Friday night with mutual fund shares and wake up on a Monday morning with ETF shares, and they don't realize a capital gain as a result of the conversion. So from a shareholder perspective, they get these additional advantages of having the additional tax benefits of an ETF wrapper in an investment approach that's tried and tested, has been around for 2 decades in these particular funds, and there's no work to be done on their perspective. So we think that makes a lot of sense for the shareholders of the funds.
So Gerard, one of the selling points of Dimensional is that it's so exclusive, and I'm wondering that, is there any concern that by making these ETFs available to the broader public, that Dimensional's advisors, for example, might be marginalized in that process?
Yeah, Katie, good question. And one thing that we asked ourselves quite a bit before we decided to move into the ETF space, and one of the catalysts for us to launch ETFs was that the feedback that we were hearing from the financial professionals that we were working with was ETFs were a requirement for them to be able to service their clients. And so with that feedback, plus the ETF rule that passed in October 2019, September, October 2019, we could do what we do in mutual funds on the ETF wrapper side. And so we launched 3 funds last year and then had the conversion of these 4 funds with 2 more planned for later in the year. We're absolutely committed to the financial professionals that we work with. We think that these are great tools for them to help the end investor. And we think that combination of financial professional, expert on capital markets that's Dimensional, is a really good combination to help the end investor have a good investment experience.
Gerard, let's talk about the process. How difficult was it to actually complete the conversion?
Oh, this was a labor of love, I have to say, in terms of a lot of work went in by a lot of parties. I really think that Dimensional is leading the industry on this one in terms of doing a conversion of size. When you look at all that had to, get organized internally, but then the custodians, the platforms, the tax opinions, and to do this at scale was really an enormous feat in my view. And I'm very pleased that we were able to lead the industry on this conversion.
One of the things that people will be familiar with, Gerard, is the Dimensional advisor kind of certification. To buy your mutual funds, you need to be a certified DFA advisor. What happens to those folks now? Are you at risk of alienating any of them?
We don't think so. When we went into virtual last year, I'll give you some examples. We transitioned all our conference schedules to virtual, a lot of interactions virtually, and we're fully committed to the support of the financial advisor. So when you think about those conferences and so on, they're all about education on capital markets, on volatility, on what it takes and the discipline that's required to actually capture the excess returns associated with small caps, with value, a lot of which that we've seen this year. So we think that is important, remains important. We remain committed to interacting with those financial professionals in that way. And as I mentioned, this is a tool that they have asked us to deliver to help them serve their clients better. So we're very excited about the conversion and the ETF launches. And we hope to have more ETFs in the future. We think that our ETF should stand alongside our mutual funds with a relatively complete offering to service those financial professionals.
Well, Gerard, I want to follow up on that because with these conversions, Dimensional is now the 11th biggest ETF issuer, at least in the United States. So what else are you looking at in the ETF space specifically?
Yeah, Katie, that's a good question. And, you know, not just 11th largest, but when you think about systematic, non-index-based approach, 99% of the existing ETF assets in the equity space are indexed. And this is something new, something different coming to the ETF space. So I think that's even more exciting. Yeah, we want to have a complete lineup. So we want to have all the asset categories covered. We're doing research into fixed income right now and looking at what types of fixed income ETFs could complement the equity ETFs that we have out there in the marketplace. And by the end of the year, we'd like to have a more complete lineup for the financial professionals that we work with to be able to use for their clients.
Well, while we're looking out into the future, Gerard, let's talk about the future of active versus passive management. Where do you think things are going to settle out in that battle royale?
It is really a battle royale, and what I can tell you about Dimensional is that we try to take the best of both worlds. So we try to be wrapper agnostic. You like mutual funds, great. You like ETFs, great. You like separate accounts, great. And also take the best of what we see out there. Indexing has lots of good features, you know, low cost, low turnover, broad diversification. And then there's some things on the implementation that active management has some good features in terms of, you know, understanding markets, how you trade, how you turn a portfolio over, how you do your research into capital markets. And we try to combine the best of both worlds. So where I hope it all goes is more in our direction, which is more towards systematic, fundamental, or kind of that indexing 2.0, which we've been doing, I think, successfully now for 4 decades.
Well, Gerard, what caught my eye about these funds, in addition to being some of the first conversions, is that they're active, but they're transparent as well. They disclose their holdings every day versus, you know, on a semi-basis like mutual funds. Why did you choose to go fully transparent versus, you know, semi-transparent?
Well, there's a couple of benefits, I think, to fully transparent, and that comes in the spreads, really. When you have this active transparent approach, I prefer to call it really non-index transparent approach, because those holdings are available every day. What you hope is that you'll get better bid-offer spreads and better market quality in the ETFs as they trade. And we've seen very healthy bid-offer spreads and healthy market quality on the ETFs that we've launched, and already on those 4 ETFs that I've listed today. When we think about our approach, as I mentioned, is low turnover, systematic, high diversification. And so when you look at our mutual funds that make their holdings disclosed with a 30-day lag, this is not so different. We don't think that this really impedes our ability to add value in excessive indexing on behalf of our clients. So we're in that sweet spot, is my view of how our approach can be brought to an ETF marketplace, which ends up hopefully being good for all investors.
So Gerard, last question. Citigroup said in a note last week that they expect that ETFs will overtake the mutual fund industry within the next decade. What are your thoughts on that?
I think that there's certainly a lot to be said for that. The flows have been more into ETFs than into mutual funds over the past number of years. In my view, mutual funds have a lot of benefits. ETFs have a lot of benefits. And which one wins, I don't know which one will win. It'll depend on what happens to tax code, what happens to regulation going forward. But what I can say is that we're here to support the financial professional, and whatever vehicles they find useful for their business, we want to make available to that financial professional. So we're not going to make a bet on ETFs versus mutual funds. We're going to have a good, strong footing in both camps.